Hi, everyone, and welcome to the Ether Capital podcast. My name is Brian Mossoff. I'm the CEO of Ether Capital, a publicly traded company focused on Ethereum and Web3 infrastructure. This is our first time ever doing a video version of the podcast. Joining me today is Dr. Gordon Liao, who has left the world of traditional finance. He was formerly a senior economist at the Federal Reserve. He's joined Uniswap Labs, one of the most important DeFi protocols and projects in the crypto space, as head of research. He also has a PhD in economics from Harvard, and he's also worked as a fixed income trader. And so he's got a lot of experience that I thought would be really interesting to share with everyone, and different perspectives of how he existed in traditional finance and why he's so fascinated by crypto. So Gordon, my eyes are going to go to you now and say welcome all the way from Honolulu. Thanks for joining me virtually today on our podcast.
Thank you so much, Brian. It's good to be here.
Why don't we just go way back to, when you were doing your PhD in economics, were you focused at that point in time on traditional finance and wanting to be part of that world? And then run us through that experience and how you basically ended up at the Federal Reserve.
Sure. So I actually started my career first as a fixed income trader for the Harvard Endowment and later did a PhD. It was actually doing my PhD where I was mostly focused on financial frictions in traditional markets, but that's also when I first gained exposure to crypto. So it was around the time when Bitcoin was having probably the second wave of price ramp up. And I was surrounded by really smart classmates of mine at Harvard who were actually mining Bitcoin on the side. And one of my classmates
also, by the way, can you just give us the year so we know, where?
Yeah, so this is around 2013.
Okay.
And they were mining Bitcoins on the side. And I know they were really smart math geniuses. So I know that this is something that I should look into. So when I first looked into it, it appeared to be, it's quite interesting, the concept blockchain, proof of work consensus mechanism. But I come from a more traditional finance mindset, so I viewed it largely as, okay, it's a cool, new speculative asset of some sort, but largely dismiss it as a technology that could have major impact. Now, fast forward a couple of years with the rise of Ethereum and DeFi apps. This was when I was also, at the time I moved to the Federal Reserve, I began to recognize that, this is actually, real transformative technology that's beyond just a speculative bet on an asset class itself, rather that this asset class represent really a shared state machine or a computing environment that allow new applications to be developed and new users, new usage across both DeFi and non-DeFi use cases.
I guess one counterpoint to this, or one way that traditional finance would like to think about the space, is they like the idea of blockchain tech, this idea of a blockchain shared consensus, but they're skeptical that you actually need a token. And maybe some of that has gone away over time, but you must have heard a lot of these conversations, the blockchain, not Bitcoin, or we like this blockchain thing, we just don't want a token to underpin the consensus. Can you talk about how you think about that? Why do we need these tokens? Why do you need Bitcoin and Ethereum? Why can't we just have some kind of shared state machine globally for other people to build on, but not have some token where you can treat it as some speculative asset?
Yeah, so I think the token component is a way of, one, incentivizing growth for early adopters, and two, is a way of accounting. So when you think about different protocols interacting with the users, you have to have some way of accounting. So, in a traditional two-sided platform, that might very well be just fiat currency, in which, say, if you have a two-sided platform like Uber or Airbnb, the users are transacting in fiat currency and incentives are being paid out in fiat currency. I think what token does is, one, it gives rewards to early adoption of the technology. So instead of paying, say, incentives in fiat discounts, ones could be incentivized through token that are either airdropped or could be acquired at an earlier phase of the price. Two, I think it is important to have units of account that are native to the internet, that are native to the DeFi system. And tokenization doesn't have to be a speculative process either. That's why there are stablecoins around, which is basically tokenized dollar or tokenized deposits, which are stably pegged to the dollar.
So go back to, before we dive into all the crypto stuff, while you were at the Federal Reserve, what kind of things were you thinking about while you were working as a senior economist? What kind of problems did you see in the traditional financial system and the structure between having a central bank and commercial banks? What were some of the things going through your head while you were on the inside of that environment?
Yep. So at the Federal Reserve, I was working at the Federal Reserve Board in DC. There are two areas of my focus. One was understanding market frictions, and especially frictions in short-term funding market, in bank-led intermediation, and policies that could address these sort of frictions. Two was, by and large, understanding technology developments, innovations in distributed ledger technology, innovations in blockchain, that could also contribute to digital currency, stablecoin, et cetera. I see there were so many market frictions that were a function of balance sheet constraints on part of large intermediaries that were quite problematic. To give an example, I did a deep dive in the aftermath of a large repo spike in September of 2019, when the short-term repo benchmark rate went from, at the time, it was close to zero to all of a sudden 10% intraday. And that was a particular instance in which were clearly market frictions that are created by the constraints are placed on bank balance sheets. And I think with newer technologies such as non-intermediated finance that are possible through blockchain technology, we're able to remove some of those balance sheet frictions because you're taking away intermediaries that are in the middle.
But do you see any of traditional finance and all of that infrastructure ever using open source, Bitcoin, Ethereum networks to facilitate any of their transactions or flow of funds? Or do you think that these are going to be two separate worlds?
I see there's a lot of experimentation being done currently at various central banks. And many of these experimentations are building on top of open source software. So taking the core codes that are in open release and modifying it. So there is possibility of a world in which we have major infrastructure, financial infrastructure built on open source platform. I think that's a really real possibility because we understand the constraints of having siloed walled garden type of environments, because it creates perverse incentives of creating, institutions are too big to fail, single points of failure, as well as simply not having enough checks and balances. So if you look at how some of the major blockchains and DeFi apps function, you have so many sets of eyes looking at the code, making sure that it is safe and secure. And through experimentation, I think we get to a better state. If we take that and only place it into walled gardens, where only a few developers internally could maintain the code, then you end up in a situation where you could have single points of failure that are quite important to the financial system.
It's an interesting way of thinking about what safe is going to mean in this new world. And I've had a number of conversations with various regulators and government officials and policymakers. And in the, I guess in the 20th century, what safe meant was stamps of approval from audit firms and procedures that they had put in place over that century for those types of institutions. But when I think about what safe means in something like DeFi or interacting with any blockchain, the thing that makes me feel safe actually is knowing how many developers looked at the code, how long that code has been out there. And if you tried to map an audit firm to say, well, they looked at it and stamped it okay, I don't know that that helps that much. I mean, maybe it gives some credence and maybe they have their own internal development teams, but I think we're going to have to redefine what safe means in this new space. While you were at the Federal Reserve, did you start going back to those initial ideas around crypto and thinking about your friends who are mining Bitcoin and saying, I'm going to do a deeper dive. I want to look into this. I want to be a part of it, and consider leaving that job from a very, respected agency to, I want to go work in crypto full time. How did that transition take place?
Yeah, so at the Fed, I was both a part of the International Finance Division, as well as part of its own technology lab, where really experimentations take place, and we openly invite industry experts as well as academics to discuss the newest developments on the technology front. There is when I first started experimenting with distributed ledgers and thought about, this is actually really cool as a innovation. Started doing research on central bank digital currency and stablecoins internally, which have gained some traction. But I also realized, it's better to be at the ground level, trying to learn from the best developers who are working in this space. And that's when I decided to look outside and specifically joining the DeFi industry.
And so why Uniswap Labs specifically? I mean, it's certainly one of the most respected projects in the space. It changed the game on what an exchange or an ability to swap an asset would be, and remove some of that counterparty risk from the centralized platforms. Why was that project specifically so interesting to you?
Yeah, so I think there are a couple of reasons. One is I think exchange services is at the core of asset allocation, is at the core of basically price discovery. And this is such a crucial part of financial system to have the ability to trade. So that's why I think Uniswap protocol itself is a fundamental primitive that could be used for many things in DeFi as this space develops. And another reason is, purely because if you look at the landscape of DeFi firms are engaged in DeFi out there, not many of them are very open. And in part, this is because we are in an ambiguous state on the regulatory front. So many of the projects, you can't really find who are the people behind it, at least not openly. It's oftentimes anonymous developers or developers who do not share their names widely. I do like the approach that Uniswap Labs, as well as some of the other larger projects are taking, which is to make their name known and have an open dialogue with the broader world. I think it is when you have open dialogue with traditional finance, with policymakers, that you're able to take this innovation to the mainstream, to the next level. So that's also what excited me quite a bit.
So you think that is there a world where we could have anonymous developers as well as known developers working on protocols together? Or do you think it's important that everyone is known, doxed, blue check mark on Twitter? We know who's behind these applications.
I think that's a tricky question. There's probably some legal implications to that as well. But personally, I have no problem with anonymous developers out there, as long as the work could be verified, as long as somebody know, maybe not open, but somebody, maybe the employers know who they are. So I think there's definitely a world in which, and this is how open source software typically works as well, right? You have different people submitting pull requests on the same GitHub repo, and you have contribution from a variety of external community members that doesn't have to necessarily have an official affiliation with the open source project.
On to, I guess, a hot topic of today really is around what is KYC and AML going to look like in crypto? This is a conversation against a backdrop of global sanctions, a war happening. There was some events in Canada around the Freedom Convoy. And so governments are waking up to this idea of how anonymous can we let crypto be? What kind of choke points do we need to put around this asset class? And I guess what I'd ask you is, do you think that DeFi works if you apply KYC to everyone who would be in, let's say, a Uniswap pool or interacting with a specific protocol? Or can we have a world where we don't necessarily need to KYC everyone on both sides? How do you reconcile these ideas?
I don't want to take a specific stance on KYC or permissionless, but what I could say is the way that public blockchains are set up is it is incredibly transparent. Within hours of, say, the wormhole hack that happened a couple months ago, you have companies like Uniswap Labs basically being able to trace out all the addresses that were affiliated with hacks. With the Russian sanction, you have a list of OFAC published list of addresses. In addition, you have analytics companies that were able to map out all the affiliated addresses to those sanctioned entities. This is a level of clarity that you actually don't necessarily have in traditional finance. There are $2 trillion of physical banknotes circulating around, and around 80% of those are in $100 bills. Do we know what those $100 bills are being used for every day? We don't. We kind of turn a blind eye to it. But do we know where money is flowing on a blockchain to some level? I think we do have some sense of it because you're able to observe the fiat on-ramps and off-ramps. And that gives a lot more clarity in comparison to physical currency, for instance. Can we do better? Probably, but that's a longer discussion that would probably require both thoughts from technology leaders, as well as policy leaders, as well as legal scholars.
Where do you think, as someone who's been on the inside, you've worked at the Federal Reserve, you've worked in traditional institutions, where are they hung up on crypto right now in either not seeing the opportunity or being afraid of it and thinking that the only purpose of it is to money launder, terrorist finance, evade tax, and that there's no real use case for crypto? Where do you see that educational gap being, and how do we solve for it?
Yeah, I think more and more so, if you speak to just the average traditional financial companies, they are recognizing that there is immense opportunity here. This is a transformative technology that could be used for good. But where I think it's lacking actually is regulatory clarity, having clear boundaries of what is allowed and what is not allowed, and having boundaries that could also help developers to figure out how to develop better, for the anonymous developers to come out in the open, because there's so much ambiguity. And I think that could enhance adoption as well, to have more clarity onto the future from a regulatory standpoint.
Talk to me a little bit about the stablecoin report that you had been working on for a while and how you see stablecoins playing a very important role in the future of DeFi and on these blockchains. And for everyone who's not familiar, a stablecoin is just a tokenized version of a dollar, and there's different flavors of it, whether it's collateral backed, whether it's running an algorithm. But anyway, for anyone who doesn't know, that's what a stablecoin is. So yeah, if you could shed some light on kind of how you're viewing stablecoins, what works, what doesn't, where you see this going, that would be very helpful.
Yeah, so mapping to the base use cases of finance and answering your earlier question as well about tokenization, stablecoin at the base level facilitate things like payments. But beyond payments, it has a crucial role currently in the crypto capital market, in the digital capital market. And eventually I see it being potentially broadly adopted for beyond digital assets, but for, say, cross-border transactions, streaming payments, even just day-to-day payment services between different companies. Now you might ask, we have our payment system already. Why use stablecoins as another form of payment? Well, I think one is because it is native to the blockchain, it would support a lot more applications. And two is the technology is much better for anyone who have done international transfers or even domestic wires. You have to pay a certain amount of fee and also wait a period of time for settlements to occur internationally. Now, blockchain rails, stablecoin transactions usually happen, within a minute. And that's a dramatic improvement when it comes to situations that require payments to be fast. For instance, delivering aids to different countries, such as Ukraine right now. And I think the Ukrainian, related to some of the Ukrainian aids that were provided recently were through blockchain rails through stablecoins. So in the research I did, I mainly focused on the large systemic type of risk and really discussed, the different ways in which we could overcome these type of risk and whether these risks are important or not. One side of it was assessing the historical stability of stablecoins. And the other side of it was understanding, as stablecoins expand its adoption, going from currently just below 200 billion to perhaps in the trillions of dollars, what potential impact it could have on credit intermediation, or in other words, bank lending to consumers and businesses. And I'm happy to dive into each of those topics more in depth.
Yeah, if you want to shed some light on it, I think what you see the risk being and what the opportunity is would be helpful for people.
Yeah. So on the risk side, what often policymakers cite is how stable are stablecoins to begin with. And on that work, what we looked at is historical episodes of market sell-offs, both in the crypto market as well as in the broader equity market. In those episodes, what we find is actually surprising that for large reserve-backed stablecoins, that is stablecoins backed by fiat reserve, either in the form of bank deposits or something really safe, such as T-bills, these type of stablecoins actually tends to appreciate relative to the dollar during times of market crash. And the reason for it is simple. It represents the digital currency equivalent of the ultimate safe asset because it takes down the property of the US dollar. So when people are selling risky, volatile cryptocurrencies, stablecoins actually generally appreciate. So this is quite different than our previous understandings of, there's many people draw analogies with money market funds. Money market funds, as you might know, had a large issue around the financial crisis. It broke the buck, meaning that the net asset value was actually below below $1. Stablecoin, usually the demand has been, historically speaking, that there is more demand for stablecoins. So the same type of run risk actually doesn't present itself in the way that it usually presents as a traditional money market fund. But of course, we've seen some stablecoins fail. These are mostly experimental algorithmic stablecoins that were experimenting with different types of structure for the peg.
And what do you think? Yeah, I was going to say on the opportunity side, I mean, why should regulators and governments lean into stablecoins and want tokenized versions of their dollars to exist on these blockchains where they lose a little bit of control, or is that a misconception? How should they look at this in a positive sense?
Yeah, I think it's a misconception in that they lose a little bit of control, because how much control do you have over $100 bills, right? The control you have over $100 bills which is around $1.6 trillion in circulation out of the $2 trillion circulation of all banknotes, is that it's hard to move. But that seems to be a inconvenient reason, because it is hard to move physical cash. We'll have more control over it. Ultimately, I think stablecoins provide one competition with traditional banking, which hopefully will help raise the level of deposit rates to be more competitive for traditional banking as well. And ultimately, that will help consumers and help businesses as well. On the other side, I think stablecoins is a technology that's so core that could help with many aspects of payments, with financing, with international capital flow. I think those are areas, if stablecoins were to gain adoption, that could be a huge area of expansion.
So focusing on your role now at Uniswap, you're the head of research at Uniswap Labs. What does that entail? What are you researching? What are you most excited for?
Yep. So at Uniswap Labs, I'm building up a research and data science team to focus on a couple of areas. One is to better understand our users and as well as the DeFi ecosystem through looking into the on-chain data. So this is where public blockchain shines, is because all the transaction records historically are automatically archived, but we need to make sense of them to understand who are the liquidity demanders and liquidity suppliers. Do we have the best incentives in place for markets to operate efficiently? Two is to both utilize the data and also my training in economics and applying things like mechanism design to improve the protocol, improve the product over time. And three, yep.
I was going to say for people who also don't know how Uniswap works, do you want to also just give some quick high level on how it's different than a centralized exchange running an order book, so they understand kind of how you're thinking about when you say protocol design, what does that mean in changing incentives? If you could run through just what Uniswap kind of is, I think would be good for some people.
Yep. So Uniswap Lab have in the past created three versions of the Uniswap protocol. The Uniswap protocol is a automated market maker. What that means is it's a neutral platform for anyone to become a market maker by putting up assets that they own into a collective pool. And this pool, using smart contracts, is able to make market for other people to trade against. And the incentives for liquidity providers or those who put money into this pool is that they're able to collect a portion of the fees for every single trade. And for the traders, they're able to use this protocol and obtain what we observe to be superior liquidity compared to many of the centralized exchanges.
So and why is that superior liquidity or just a superior experience?
Yeah, so if you think about the superior liquidity side, traditionally, those who could make market on limit order books are a very tiny slice of the financial market. There are generally high frequency funds that are trading sub seconds or milliseconds. And there's just so much technology barrier to be a market maker. What Uniswap protocol does is allows anyone to come in to potentially be a market maker passively by putting up asset into a liquidity pool, and based on the algorithm, being able to provide liquidity and do market making activities. That is a fundamental shift, and it opens up a floodgate of capital to much more beyond this small slice of professionalized market makers to a broader set of both institutions and even retail individuals who are able to engage with the protocol and become a liquidity provider. And ultimately, that leads to both higher liquidity and a better experience for those who are participating in the market.
What do you think some of the fantasy features would be? If you could fast forward 1 or 2 years, what kind of things would Uniswap implement? You don't have to give away secret sauce of things that you're scheming right now, but what do you think is missing from the Uniswap experience or the DeFi Swiss Army knife of products that are out there? You've got Aave and Compound focusing on lending. We have insurance products emerging. What do you think is still missing that maybe Uniswap can offer or bring to the table in future releases?
Yeah, so without spilling any secret sauce, let me just give you some of my longer term visions for the industry. I see the potential for DeFi more broadly to be used and integrated very well with traditional finance. That is, being able to settle things such as FX or potentially tokenized assets in different asset classes, being able to trade them, being able to lend these all on DeFi rails. And why is this important? because as I mentioned earlier on, I think there's just so much intermediary frictions because of balance sheet constraints that could be resolved through smart contracts. And secondly, I think there's actually quite a bit of gain that you could have with the transparency that is offered through public blockchain. That will be a huge improvement even on the risk management front. Having things like real-time margining to avoid situations as we have recently seen with the nickel market. That would be a real world application where you're taking real world commodity and being able to trade it on blockchain rails and do things like real-time margining, allowing a better safeguard for our institutions and market participants are participating without building up too much leverage.
I think that there's definitely excitement for all the innovation that's happening in the native crypto space. And then there are these ideas, as you're saying, about tokenizing stocks and bonds and using public infrastructure to kind of settle those assets or have a wider array of participants in any of those assets and trades. How do you see that actually happening? Like right now, these are ideas. I mean, the traditional finance coming in and participating, it feels to me more like an idea than something that's really being experimented with. What are some of the things that you think need to happen to move that world into a public blockchain? What infrastructure needs to be created? What kind of new pieces of monitoring tools need to be put in place? What does that roadmap look like in your head?
In my head, we do need clarity on the regulatory front. We can't have tokenized asset without clarification on what assets could be tokenized. But already we have seen that, for instance, stablecoin to stablecoin trading in different currencies, that's essentially a FX market being developed on chain that settles 24/7. So FX market already trade 5 days a week, but closes down on the weekends. Already we can see development and growth in FX trading on chain. And that's already a step towards that direction, but with more regulatory clarity, perhaps we could get other asset classes being traded on chain as well. Second, I think there is some gap between the DeFi world, which require you to have self-custody of private keys and et cetera, and the traditional world where you have, of course, a set of institutional standards. The custody cannot just be a private key being held on a ledger somewhere. It has to be secure and safe and have different backups. That's a technology and business development that eventually will grow. And then there's many parts that needs to glue together, things including data, including platform and interface. The day I see, for instance, if later on I would be able to say just trading an asset as I would normally on say a Bloomberg terminal, and that will be the day when you really see DeFi being integrated well into the real world traditional finance. The trading should be seamless, and people shouldn't have the need of knowing how to do self-custody, and institutions shouldn't need to figure that out.
We're almost out of time here, but lastly, what I'd ask you is, outside of what's taking place on Uniswap, what else are you excited for in the space, and where do you hope the space will be 5 years from now?
So outside of Uniswap Labs, I continue to be very excited about stablecoins and the real world use cases for payments and remittance, et cetera. I do think, this is related to my research, having ways to do under-collateralized lending, that will be important, because if you think about it, stablecoin will ultimately compete with not only physical currency, but also bank deposits. And for bank deposit competition, you want to create credit on the other side. So having a system of establishing digital identity to be able to do under-collateralized lending, that could be an area of growth, and I think it's also an exciting area.
We're out of time, so I'm going to say thank you very much for coming on, and hope to catch up with you after the next year or two and see what's taking place at Uniswap Labs and where the industry is then. So hope to see you soon.
Thank you so much, Brian.